start our webinar. I'm delighted to welcome you all to this third webinar in a series of 4 on financial management for social entrepreneurs. For those that are joining us for the first time, my name is Luisa Ferreira, and I'm the head of the social program at European Investment Bank Institute, and I will be your host and moderator for today's webinar. And I have with me Thomas Ferré, which I have the pleasure to introduce. Thomas is the speaker of the 4 sessions on financial management for social entrepreneurs. Thomas works at European Investment Funds Mandate Management Equity Team, and in addition, is a former social entrepreneur himself, so he understands you very well with a previous career in venture capital. So he is really the right person to answer any questions you may have. Today, Thomas will walk us through step 3, which is on the business model. Thank you for having listened, and now it's time to invite Thomas to join us. Thomas, the mic and the screen is yours. Thank you.
Thank you, Luisa, and thank you, Denise, for inviting me to do this webinar series. And for coordinating everything so that we could still have it in spite of all the things going on right now. I wanted to also thank all the people who have been asking questions in the previous sessions and for all of you for attending. It's been very interesting to hear some of the feedback and also get some of the questions and sort of adjust the presentation based on the questions that we received ahead of time. So just for connection reasons, to make sure that there's no connection, I'm going to just turn my video off. It's okay. What's important is not me, but the slides. So hopefully we really want to make sure that the audio connects well and that there's no issues with that, because then it goes on YouTube. So this is also a reminder, as Luisa said, that you can always go back to watching specific elements of this video later on in YouTube. So, as Luisa said, this is part 3 of a 4-part webinar where we talk about the financial aspects of your startup and of your scaling, in particular around the concept of fundraising. And in the first session, we talked about the capital structure. One of the things that we insisted on, or I insisted on, was that founders really need to be careful about understanding well what is debt, what is equity, and the difference between those, in particular, the implications of the kind of investors they get on each side between good and bad times in the life of their company or the economic environment. We then narrowed it down to VC investors. VC investors, they're return maximizers, so they invest on the equity side, and they're risk minimizers, so they put in debt features, a lot of debt features, in their equity investment. And the reason why they have this type of profile is because they invest in businesses which overall have an over 80% failure rate. So they really want to take the right risk return approach. We also talked about how the valuation looks at both the upside of your business, but also a lot of the risk elements, including risk of failures, lead times, the dilution through rounds, etc. And so it's really important for you to understand these concepts and how the VCs will look at it to make sure that you're able to have a good conversation with everybody. And we also talked about the concept of fundraising itself, how it's important to be able to plan ahead of time how much cash you're going to need, how long it's going to serve, and how much time you're going to dedicate for that process. And really, we encourage you to not make it a full-time job for over than 6 months, because the time you take away to fundraise is time that you take away from your clients. And there's a way to fundraise here, bits and pieces, through a lot of conversations before getting all the documents in order that will be very close to a final version of the documents. 2 important rules that I repeated over and over and over are that you need to put your best foot forward. So do your research on other startups There's a lot of databases out there that are free and public. Look at other fundraisers VCs will be interested in hearing about. Look at their portfolio. Like at how they invest. And their valuation. You know, companies that have been successful. Element of this is there's a lot of information. So really, exploring the web and experts in your industry. And getting them to help you understand some specific elements. We're going through today. We're going to talk about key aspects to look at your scalability story. We're going to look at how fundraising can serve your scalability in a very short slide. And we're going to look at main concepts, main business concepts, and financial implications to focus on. And that's really a deep dive into 5 elements. One is clients, another one is price, third one is product, quality cost over your scaling life, your growth, and staff implications. Also, since this is a webinar that targets social and impact entrepreneurs, we're also going to look at how impacts correlate with all of this. The main takeaway of today is growing client margin. When you think about fundraising, you have to think about how do you scale through the pressure of growth and create the repeatability of A, your economic value proposition to clients, B, your sales pipeline, how do you grow it, and how do you maintain effectiveness in converting the pipeline into actual clients, and then C, your product quality. And all of that, if you manage it well, you'll be able to create more clients and better margins. So I also wanted to spend time on what today is not. Today is not a pitch deck prep. It does help. We focus on core elements of your business model and your scalability story. And that will inform your deck, but we're not going to go over any slide that we should say this is a slide that you should have in your pitch deck. It's not a financial model prep, but it does help a lot because we're going to talk a lot about concepts and relationships between business items or business elements and financial elements of your business. It will help you understand better the relationship between those and understand cash flows, etc. I'm told that my audio is not that great. Can you hear me better, Denise? Okay, so I'll try to speak perhaps slower. So today is not about preparing for a financial model. We're not going to go on Excel and do things. It's really about helping you understand key elements that will make you put together a better financial model. Before we go into the elements of scaling, we assume that this really targets entrepreneurs that have established that there's a real problem, they've already started solving it, they identified who their paying customers are, what they look like, how much they want to spend. They've tested and built a proof of concept, an MVP, already are past piloting their products with paying clients. And I just want to summarize the key of this slide. This slide is really trying to focus on one aspect of your business model, the scalability and the story, how do you put it together, what's important. And all of the other elements, the pitch deck, the financial model, and other elements, they deserve their own webinar. So, in fact, more than 1 hour to be dedicated to those. So I don't want to spend too much time on those elements. And if that's really something that you want to hear about, we can spend more time on another webinar. Okay. There's going to be 2 parts to this webinar. One where we cover a simple framework for your growth and scaling story, and the other one where we do a deep dive into the 5 main components of your scaling. The important aspects of this poll was to really make you think, what's key for you when you're thinking about growth? Is it client growth? Is it profitability? Is it product quality? You really want to make sure that through your growth story, your product is a very reliable and high quality product. Is it liquidity? You're making sure that you have cash through your growth. Is it team culture? You want to make sure that employees really continue to adopt that team culture that was at the beginning and continue to be happy through that. The team quality, how good are your hires? Operational tools to enable growth, the kind of tools that will help you make the best of your entire team and products and relationship with customers. Your impact, or perhaps your brand, perhaps that's the most important for you, is the brand. So before we take a look at this, I think it's important to ask ourselves, what is a company? And this is really a simplified view, but I think it's really important to reestablish what's your starting point for creating a company. Starting point is there is a client. Client, to me, is the most important part of your business. Client has an issue, and you're trying to solve it by bringing it a product. And so to bring that product to the client, you need to develop a set of things, which includes people, processes, and profit. And within that, and so the aspects of profit is very important, because when you're thinking about being an impact company, no profit, no impact. It's very important to understand that. And then the impact really is, if you will, and we look at it on the business side and financial side of things, is the positive impact means a sustainable business. If you're continuing to generate stakeholder value and deliver the impact that people are looking through in your products, then you'll be able to continue your sustainably your business. So now let's look at another definition. What is scaling? Scaling is growing your clients and your margin. When you're an entrepreneur, your margins aren't great because you haven't established your best cost for your product. You haven't established a brand that allows to generate inflow of clients. And so there's a lot of things that go into this. Let's take a look at it a little bit deeper. One, let's put on the same level impact and profit, just for simplification. We're going to talk about impact at the end of the presentation. So impact correlates with profit and revenues. And so profit is basically the difference between revenues and cost. That's fairly simple. Everybody knows that. Revenues, when you look at revenues with the goal of scaling, you're looking at clients and price. As an entrepreneur, you're saying, okay, how many clients do I have today? I want to scale. What does it mean to me in terms of scale, in terms of number of clients, my target number of clients after the fundraising? What is the market potential? That is going to start constituting my scaling story. And in terms of price, when we're an entrepreneur, we have a very small panel of clients through which we test our price. So when we scale, how do we make sure that the pricing is strong enough that it's going to resist different approaches to pricing, different client considerations that are going to be testing that price, different client segments, etc. So we need to think about, how do we test our price? What are the benchmarks? What is the economic value proposition, and how does it change over time? Now, in terms of cost, there's two aspects. One is cost associated to products, and the other one associated to operations. When you're thinking about scaling, you're thinking the cost element is really, I'm going to create more revenues out of my cost basis. And some elements of your cost might not change that much, but some elements should change drastically. On the product side, you're going to think, what is my cost structure? Your cost of producing, cost of selling, cost of servicing. How do these elements that are going to repeat over time change? How do the elements that are not going to repeat over time not change? And how much does all that impact my approach to my fundraising, how much cash I need, etc. In terms of operations, you're going to be thinking as you scale, or as you're thinking about scaling, how do you execute this? How much staff do you need? And, what's the salaries for this staff? What kind of software do you need? Accounting software, CRM, ERP, customer facing? Do you need to develop it internally? Do you need to buy a standard software outside? And how does that change after the fundraise? So these are a lot of considerations that we're going to go through today. But right now, what I'd like to do is go through actually a simple story about how to frame that scaling. So I'm going to look at 3 timelines. One is, for example, right now you're a company that's going to raise money at the seed or Series A level. So you already have some metrics on the basis of a small number of clients, and we're going to look at how you should be framing or thinking about those metrics after the current fundraising round, and then later on, perhaps at the exit of your when you sell your company and beyond. So let's say today that you have 10 clients, you're selling a product that, for example, you would charge 50 per day, so 50 times 365, that's your annual recurring revenue. And on the cost basis, you spend 300 for each client, and that's perhaps the cost of acquiring clients, tickets, train tickets, phone calls, databases, etc., and other perhaps hardware costs that you have to develop to spend to develop a solution for your clients. And then you're spending 300,000 on operations, which may include lawyers, accountants, and then all the staff between the engineers and the sales staff and yourself. So that means 10 clients buying every day during a year, spending for you 50, that means 182K, and then you're spending on the other side to deliver that product about 303K. Now, obviously, you're going to say, I need money because I'm losing money every year, about 120K. And just for the sake of also talking about impact, you're also in your impact, in your scaling story, you're going to talk about the kind of impact you generate, and it's important for you to also be able to establish that in your scaling story. So when we scale it, we're basically going to say, oh, I'm going to grow my 10 clients to 100 clients. How does that affect my entire company? So I'm going to go through this very quickly. We've already established what's our price. And that price, let's say, doesn't change. The product, your customer acquisition costs, some of these elements are not going to change. What might change is really on your operational side. You need perhaps less salespeople, perhaps less engineers to deliver the same value or the same number of products to these 100 clients. And so perhaps when you increase your number of clients by 10, you increase your operational costs only by 5x. So your revenue will be 1.8 million, your cost will be 1.5 million, and your profit will be about 300K. And then let's say you delivering the same value of impact to your clients, you're going to generate 10 times more. So that's 10 tons of carbon emission saved, for example. And then as you think about this, you're going to be thinking, yeah, but you're talking to an investor, you're saying, I'm raising money to reach 100 clients with your money. I'm going to spend it in operations. I'm going to spend it in customer acquisition. It's going to get me to 100 clients. At exit, I'm going to have 5,000 clients. This is my goal. And that already frames your mindset as to what exactly you're trying to go and how you're going to go then. Because then your conversation with your investors will be, okay, yeah, but how are you going to get those 5,000 clients? How are you going to get your 100 clients? Your 100 clients, it's really a consequence of, well, how big is my client pipeline, and what's my effectiveness in transforming and converting a line in my CRM or in my sales spreadsheet where I have one client in the sales pipeline into an actual signed paying customer. And so you're going to have a lot of conversations with your investors about this. What's your conversion rate from pipeline to signed customers, and how long does that take you? Because obviously that goes into that time value of money. And so let's say at exit, you're going to reach 5,000 clients. That's your goal. So you're going to talk about it in that way. You're going to talk about how it changes your economics on the product side. Is it still 300 that you're going to spend per client? Is it going to be less? Your operations, you have 5,000 clients. You generate 91 million in revenue. Is it still actually the same 50 that you spend? You know, can you talk to me about your client segments? Can you talk to me about how they're going to want to continue spending the same price of 50 10 years later or 7 years later? Perhaps you're going to add new features, new products, pivot to a new strategy. You're going to have to talk about this. And then on the operational side, the 60 million, how do you justify this? So, you know, you grew 5 times when you grew your clients 10 times. Now you're growing your clients 50 times. Is it really worth, you know, 40 times the growth of your operations? Is there anything that you think actually should be more, should be less? Can you talk to me about staffing, software, you know, markets where you're going to have higher rents and things like this? And so that is how you end up talking about your scaling your profit and your impact. And note that this doesn't stop there, because it's very important for you to say, well, you know, I'm growing from 10 clients to 100 clients after the fundraise, and that's really with a target of 5,000 clients. But ultimately, you know, the market that I'm targeting is there's a million clients. I've identified them. They're in my city. They're in this city where I'm going to expand as a second stage. I'm going to expand in a third stage, you know, outside of my country. And then I'm going to go to the US or perhaps India or perhaps this other country, Germany. And this is where the bulk of my clients are, for whatever reason. So you really have to understand the whole story, basically from where you are today to after this fundraise to at exit. And the exit also depends on your total market potential. So you need to understand also what's your market potential. And that is really going to inform your story. In fact, when you're going to talk about it, you should have in mind KPIs on a per customer per year basis. So how much revenue do you generate per customer per year? What's your gross margin per year per customer? What's your profit per year per customer? What's your impact per year per customer? In fact, you should also be talking about it as you scale through time, after the fundraising and at exit. All this is really to give you a framework to how do you think about scaling, and what are the things that you should be talking about. We're going to deep dive into a lot of these elements, but at least in concept, this is the overall, you know, high level picture. Wanted to stop for a minute and talk a little about implications for your funding strategy. So ideally, in most cases, equity funding provides additional high growth capacity. So high growth financing for high growth capacity. And high growth capacity, it's a combination of sales, because you need more salespeople to sell to more clients. It's a combination of engineers to continue to make more products, product managers for new products, executive, because you need more professional rigor and experience in your executive team, equipment perhaps also acquisitions to finance the acceleration of your growth. And the reason why you would do this is not because you're losing money, it's because you need to acquire more growth faster. And the consideration that you should have is, in my business line, for my business, for my products, is fundraising going to help me defend my position, or is it accretive? In other words, it's going to generate more value than the money that it brings me. And if that's the case, then I should fundraise. So the two questions that you should assess is your current team managing a profitable business in a sustainable way? Once you've achieved that, once it becomes a yes, at what point what do you consider should be your metrics to identify whether fundraising is actually accretive to your business and allows you to defend your leadership position, for example, or not? There's no point in fundraising money that you don't need if you can continue growing and generating value to already your owners. So let's take a look very quickly. At the beginning of the life of your company, you have a founder, you start building a bigger team that's, let's call it your minimum viable team, that's enough of a team to have a client or a couple of clients, enough of a team to develop the product in a sort of final form MVP. You've already demonstrated the concept of your product, and then you start growing into a self-sustaining and growing small company. In essence, at this point, you should be a company. So perhaps here you've already raised money through a seed round or business angels. You've put in your money. You probably have some money from family members or friends, and you've grown into a company that essentially could be a slow growth, profitable company, and that's absolutely fine. Or you could raise additional funding if you think, geez, I think 5 years from now, there's going to be more competition, et cetera, so I really need to accelerate my growth. If that's the case, raise some money if it helps you. And so that's just wanted to make a quick point about scaling and fundraising. Fundraising is not a requirement when you scale. You can do it on your own. If you have very high margins, if you're already profitable, you can do it on your own. The question is that you have to ask yourself is it worth it for me and for my company to fundraise? What am I fundraising for? And fundraising is not a KPI, in other words. So let's deep dive into 5 very important components of your scaling. Before we do this, let's look at another poll, which actually was the poll that was asked a little bit earlier. What's in your mind is the most important element of your scaling plan? Is it your product? Is it the people inside your company? Is it your profit? Is it your clients? Is it your impact? Or, perhaps for you, it's internet. Without internet, I can't get clients. Without internet, I can't build a business. My entire company is managed through video calls on the internet, etc. So please, I'm very curious to see how you understand it. There you go. Products, very important, certainly. People, less of a success there. Profit certainly is important. There was a question about non-for-profit. We're going to talk about it at the end. Clients, some amount of importance, and impact, quite important. We're going to talk about impact. It's going to be very interesting to see how you're thinking about it later on. And then no answer, no answers for internet, and then a lot of no answers. I think perhaps the poll was shut down a little bit early. Well, certainly, I've made the point through these slides that clients are very important. It's also very important to identify, what's your source of revenue. And we're going to, these are some of the things that we're going to talk about. But client is the basis of the existence of your product and your company. So let's start with a deep dive on your clients. There's 3 elements as you're fundraising and as you're scaling your business that you should consider. One is your client list. Another one is your client pipeline. And a third one is the market. When you're looking at client list, you have to look at how many segments compose your client list. How many clients within these segments do you have? How good are your clients, or how loyal are them? It's great when you're a startup to have very loyal, in fact, almost ambassadors to your products. It's a very important concept that that entrepreneurs should target. There's nobody that'll sell you better than an existing client, so it's very, very important. And then when you're thinking about client and scaling, you need to think about sales cycle and lead time. I'm going to talk about this in a while. When you're thinking about client pipeline, think about how many clients in your pipeline should you have to achieve your actual client target. How far does it take you if you have a pipeline of 1,000 clients and you have a conversion rate of, let's say, 5%, which means that out of 1,000 clients in the pipeline, you will convert 50. That's not enough to reach the 100, and that's your target. And considering the sales cycle, perhaps it's not even enough to reach the target with 50 within a year. And what kind of tools? How are you organized to really maximize that client pipeline? How do you have a funnel? Do you have tools that allow you to identify and to remind you, oh, follow up with this client, follow up with that one. Here's where the conversation was left. Here's when you're supposed to follow up. And then the last element in your total market is you never really go at your market without understanding what's the total market. And the total market, if we break it down, is what's the total immediate market. Let's say your company based out of Helsinki, how many customers you have in your immediate environment in Helsinki. And then how many customers do you think you can get in the neighboring cities within your country? And then after that, how many customers, where would you expand next based on your client profile? Is it England? Is it Sweden? Is it Denmark? Is it Germany? And how many clients would there be there? And then just grow that pie, and then to identify basically various stages of expansion, but also your total market. And that's very important to identify where your company is going. So if we take the example of you selling a product to aviation companies, perhaps in your client list, you might have one large customer in pilot testing of your product. You might have 5 regional currently negotiating a contract to start. They are past the pilot phase. And then you perhaps already have 3 low-cost current clients. And so all of them, it's important to separate those because they're going to have different pricing consideration, different sales cycle and sales lead time, etc. One good thing to always talk about, as I mentioned, about when it comes to client attrition, never lose a client. Well, unless it's for the right reasons. One thing that I wanted to mention about the lead time, when you're establishing a pipeline and you are saying, I'm a B2B company selling a SaaS product or selling a solution for corporates, it's one thing to sell to a small company. They may make, based on a relationship with you, they make a decision within a week, within 3 weeks, within a month. A corporate may take 3 years to buy your product, and 3 years might be, oh yeah, very interesting. A year later, oh, let's have you talk with some more people. A year later, oh, that's great. Let's start thinking about a contract, and then that contract negotiation might last for a full year. Some of them will actually require all of their suppliers to have perhaps 3 years of audited financial statements, because it's important for them to have reliable suppliers. So really think about, in your industry, based on the segments, who am I talking to? How long does it take to sign a contract? And also never celebrate having signed a contract if you haven't signed it, because as part of your entrepreneur, if you haven't gone through this, I guarantee you multiple times in your career, in your company life, you'll find yourself where a contract is almost signed and you're thinking that this is it, it's done. And then for whatever reason, the person who was supposed to sign got allocated to another country, etc. There's a new person, whatever reason, COVID happens, etc. They're not going to sign it. Until a contract is signed, it's not signed. It's very important. And so what that means is when you're thinking about your sales funnel in your client pipeline, you're thinking, well, I have 1,000 clients in my pipeline, or perhaps 2,000, I have a 5% conversion rate. And then I'm going to talk about all of these identified targets in probabilities. And so I haven't talked to 900 of them, but I've validated them. So typically you will say, oh, those 900 have a 5% probability of being a client. Then you've talked maybe to 50, to 100 of them, 50 of which you've already made a product demo. The product demo, you might say, oh, they're like 20 or 30% conversion rates. And then you've entered negotiation, you're probably at a 50% conversion rate. So that's very important to understand where that fits within your funnel and how that converts into your financial model. Because in your financial model, it's not because you're talking to a client that you should be writing them down as, oh, we're going to get paid that day. No. And then there's another thing, signing a client does not mean getting paid, and then talking to a client does not mean getting signed. So, yeah. So I think that's a lot of information already about clients. I talked about how to look at the markets, but these elements, please go back to them on YouTube. These elements should really allow you to start thinking a little bit deeper about your clients and how that really affects your scalability. Now let's talk about slides. I've got 2 slides about pricing, because there's 2 elements two components of consideration on pricing. One, which is the starting point of your business, as we said, is there's a client, he's spending money on something that he has a problem for, and you're saying, I'm bringing you a product that will help solve that problem and help you save money at the same time. And so you should always think about your product in terms of what's the client economic value proposition. Most companies, if you can't figure this out, you will never be able to scale, because it'll tell you so much about how your clients think, what their economics are like, what exactly, how sustainable it is across clients. And so it's very, very important that you understand what the client economic value proposition. I'm going to go through perhaps 2 examples. Let's continuing with the example of you selling a product to airlines. Let's say it's a software allowing checking it at an airport. It's obviously something that's omnipresent everywhere in the world today. And how would you think about this? Well, a company, an airline would be saying, well, I've got a problem. I'm trying to reduce cost. I feel like, if only we had something that allows us to, save cost on the checking process. And so you're saying, oh, yeah, I've got something. How much do you spend? They'll say, oh, we've got every check-in for every plane. We have 10 staff that we need to pay for 5 hours. And then we need to rent 10 desks at the airport. So overall, that'll cost us $2,000, let's say. And so you'll say, oh, you know what? I think I can save you a lot of money. I've developed a solution where you would be able to reduce by half your staff and your desk rental cost, so bringing that 2,000 to 1,000. And my solution would only cost you, let's say, 300, let's say, per flight. And so you would save 700 per flight of your check-in cost. That's about a 35% saving. Here is something that a client would say, that's something that I can justify testing that at least. Obviously, when you're thinking about pricing, there's different elements. There's the positioning that you have. Is it a premium price? I'm selling a very high-end vodka that people will pay, or the iPhone, people will pay a lot of money for that, even though I could sell it basically at half its price and still make money. There's a competitive landscape, what my competitors are selling at. There's the upsell and cross-sell potential. I could sell a basic version of my element and then upsell them with other things, and then they would realize that I might end up spending more than what they were spending initially. And I'll start with something, which is the payment structure. It's a very important element because it's going to affect a lot of your working capital. An important rule of selling a product is try to get some amount of money upfront. This is how Dell built their business. And one element that companies will say, can we pay you at 90 days? We'll pay you this price in 90 days. You really have to understand how that affects your working capital, because if you're paid at 90 days and you're selling, after delivery of your product, then you're selling 6 months before. That's 9 months before you actually get your return from the expenses that you put forward to develop that product, bring it to the client, and start testing it. That's a lot of working capital, a lot of investment on your side before getting a return. And one of the biggest elements that you have to manage from a financial perspective is your liquidity, and your liquidity is your working capital. So really understand how perhaps you can lower the price and still generate profit on your side if you get paid earlier. but really, it's important to try to get paid early. And early means before delivering the product, before investing. Try to get your customer to finance your development, in essence. Talked about the other elements. I think they're fairly straightforward. Let's have another poll as we're getting to the end here. We talked about clients, we talked about pricing. Now let's talk about the other elements, two elements, the operations, the staff, and selling to clients, selling expenses. What do you think, when you're thinking about fundraising, if you are fundraising right now, what are you fundraising for? Have you already identified your use of funds? And if so, what exactly is it for? Is it for equipment to manufacture new products? Is it hiring new staff to code or engineers to make the product? Is it hiring new salespeople to sell the product? Is it just investing in customer acquisitions, buying a bunch of databases, buying outsourced customer finding services? How are you looking at this? If for fundraising, you're looking to hire staff to sell the product. That's a good thing. And trying to invest in expenses to acquire customers, that's a good thing. We're going to spend some time on working capital. I've talked about it, but in webinar number 4, and customer acquisition costs in webinar number 4 as well. But let's take a look at operations right now. Operations is essentially where you spend to acquire revenues. If we're a client-centric company like Jeff Bezos is, we're doing everything to acquire revenues, to acquire clients, and profitability will come. For a long time, actually, until AWS, Amazon was managed as a company that would just generate break-even. And so this is not necessarily what I hope that your company faces the same fate and destiny, but it's not all of our fate as entrepreneurs. But the philosophy behind it still remains. We spend to acquire revenues and customers. So operations, I'll break it down in 3 parts, really simplifying operations, but you've got a product-facing part of your operation, you've got a sales part of your operation, and then basically you have elements in between that allow product to coordinate well with sales, to improve efficiencies of products and sales. And these are your HR staff, very important, your administrative staff, very important, IT, etc., your consultants, your accountants, etc. All these people that essentially work behind the scenes to make sure that the engine of your company flows. And the engine, we're going to focus today on, or the 2 parts of the engine we're going to focus today on are your product and your sales. So your product is composed of engineers and product managers. Engineers develop a product, product managers create new products. Sales, you've got your people that are just interfacing to sell your product. They do the calls, they do the meeting, they do the closing. Perhaps for you, it's one person managing everything. Perhaps for you, you've got junior salespeople that are in charge of validating the leads and making the first call, organizing the meeting. Then you've got another senior salesperson coming in to do the product demo and the sales pitch. And then you've got a 3rd level of people who are more in tune with legal elements of the closing, and so they'll make sure that the product demo converts into and the negotiation around the contract converts into a successful sale. And then you've got your customer success. So that's really the part where you ensure that your product is used in the right way and provides value to your clients. When you're thinking about scaling, on the product side, I've known a lot of companies that have gone from very successful to basically the brink of failure just because they failed to manage the scaling of their products, their production side. So they had successful product. They came to market with a version 2 and perhaps a demand 10 times bigger, and they were incapable of delivering. They had manufacturer issues. They had service provider issues. There was a whole number of integration issues, etc., of aspects that they didn't anticipate enough ahead of time that basically killed their company. And so the operational side of scaling and scalability is a very important one. You need to be ahead of that to be able to make sure that you can deliver the product at 10 times the same number of clients. So think about quality control. You already have metrics that allow you to establish quality control. Have you already validated your future service providers or manufacturers? Is your supply chain delivery and your logistics, are they really tight? Do you already have a number of KPIs assigned to them to really make sure that you can manage them as you scale? You have a strong sense of your lead times within your supply chain. And then finally, of course, scaling is about growing your revenues and your margins. So do you have a good understanding of your costs, all your costs at scale from the product side? And then one of the most overlooked cost item happens on the sales side. It's your customer acquisition cost. So I'm very glad that most of you are looking to fundraise to really get new clients, because this is how you should be thinking about it. One of the most undercalculated and overlooked elements of that process is your customer cost acquisition. One is because people don't necessarily understand their conversion rate from a validated sales lead into a client. They don't necessarily understand the lead time. Also, they don't understand the everything that goes into converting a customer, selling to customers, whether it's train tickets, whether it's phone calls, whether it's lawyers, whether it's lawyers that you're going to pay to do 10 revisions of the same contracts. That's happened also where you think, oh, I'm going to spend $300 per client on a legal bill, and then you end up spending for a large corporate perhaps 5,000 euros. Well, this is your first client or your 10th client, and you actually have to spend 10,000 euros on a legal bill for a contract negotiation because you want it really ripped tight, and they're spending a lot of time, nitpicking a number of small elements. How does that affect your working capital? So it's very important to understand how that affects you, because the customer acquisition cost, if you make a mistake by 30%, when you scale your customers 10 times, that's a major mistake. Okay, so I think I've made my point. The most, as you're thinking about your KPIs and understanding your financial management on the quality side, on your product side, and on your customer acquisition side, think about how that changes, from going to one client to 100 to 1,000. We all have different businesses. Perhaps for you, 1,000 clients is way too much. All you need to make a few millions in revenue and perhaps in profit is 100 clients or 5 clients. Certainly, that might be the case for airlines if you have them as clients. Perhaps you need 10 million clients to generate a profit if you're running an app. So obviously that changes for you, but it's very important to understand that. One of, for example, from my experience, one of the things that I really had to understand, and I understood really quickly, is 10 years ago when I was an entrepreneur, I had a whole customer acquisition plan for online ads, and so I basically knew that I knew that running an ad on Google would cost me $150 to acquire one customer. Running an ad on Facebook, I think, even though an ad was just a few cents, actually would cost me a lot more than $150 to acquire a customer if I would be able to acquire any. And then I did a Kickstarter project, and that cost me quite a bit of money. And it was also interesting to see when you're running a Kickstarter, what that meant in terms of really understanding your financials and your economics, in terms of what's the minimum number of order that I need to produce that makes a client viable or a sales process viable, and all that stuff. So very important to think about those elements. I've made that point regarding sales and production. Is your supply chain ready to deliver on sales? Let's have another poll as we reach the end of this webinar, and this is really about impact. what is the impact for impact companies? Is it a feature of your product? Is it the actual product? Is it your corporate identity? So a feature of your product, benefits of what you sell. Actual product is a use of what you sell, and company identity is who you are. So I think it's very useful. These are not the results I expected. I think understanding that. So basically, let's call it 2/3, 1/3, or perhaps a split. Feature of your product and then the actual company identity. It's useful for you at least to get a sense of where is your impact, and let's take a look at these three elements. So you've got your feature, your product, and your identity. Why is it important to recognize that if impact is a feature of your product is because you need to be able to understand whether when you're selling a product, are they buying a product or are they and how much are they willing to spend on the feature? So if you're selling apparel, how much are people willing to spend on eco-friendly or organic cotton apparel, or sustainably sourced apparel, or sustainably sourced and locally made apparel? And you should look at it as like, how many clients am I able to get for that, and how much more are they willing to pay versus an average product? And that will give you a sense. And so you'll say, okay, if I'm pricing it, at the same level as any apparel in this category, are people still willing to buy it from me? And what's the difference in terms of total revenue for that product? So really, it's important to understand whether it's a feature or it's the actual product. So apparel, the function of an apparel is apparel, eco-friendly is a feature, function of food, organic food is a feature, energy, there's renewable, non-renewable, renewable is a feature. What's not a feature is when you're selling, for example, if you're managing a forest and you're using the carbon credit, this is an actual impact product. If you're doing impact consulting, how do you improve CSR within a company, or perhaps education, if you see this as an impact product, that's a product. And then you don't have to really ask yourself, what's the value add of my impact, because it's directly correlated to, it's directly your product. And then impact as an identity, and this would be fully circular company with impact accountability. And why are we talking about this? It's important for pricing perspective, but it's also important for understanding how do you talk about scaling your impact. So the most basic form of talking about it is to tie impact with product, and product is tied to clients. So this is how you bring the link from impact to clients. Certainly you should have impact per client as a metric per year, but you should really link it to product. That's the easiest way in your Excel model, for example. But the more you integrate impact in your company, perhaps it changes the efficiencies of your company. People are more engaged, perhaps. You have people who are willing to accept a lower salary than they would if it wasn't for impacts. So perhaps you've got more assets that go into the actual impact. Perhaps your processes also generate impact. Perhaps all of these, your processes, in fact, might generate new products out of your impact. So, in the end, perhaps your impact relates to all of those things. So you really have to be able to establish the link between impact and various elements of your company, and establish out of that the right KPIs to monitor these impact achievements. So at this point, we've concluded the webinar, which has been a little bit longer. Certainly, I planned a lot of things for today, but it's been a little bit longer than the usual ones. We have a few questions. I wanted to wrap up by at least reminding you of the takeaways of today. What does all of this mean to you? Fundamentally, your growth depends on the repeatability of your economic value proposition, your sales pipeline and effectiveness, and your product quality. All of that through the spectrum and the pressure of growth. Scalability is about getting more clients and increasing your margins. That's very important to remind yourself. To this end, a few questions for you. Have you talked to experts in this industry about the business, about some of the concepts that we went over today? Have you clearly identified paying clients who will love this product that can be ambassadors for you? Have you identified your sales pipeline, the second and third wave of clients, where you're going to get them, how much it's going to cost you? Is that a realistic, considering your sales effectiveness? Are you going to get your actual target number of clients? So how much should your pipeline be? How big should your pipeline be? Have you priced your product well? Have you taken into account the economic value proposition, benchmarking, et cetera? Are you able to cost effectively replicate your existing growth? Have you anticipated changing nature of your cost through scalability? How confident are you of your understanding of the financial management of your company? That's certainly very important within your, to manage your KPIs, your working capital, et cetera. And because ultimately all of this is going to affect your cash flow projection. So with that said, that's a lot of information. Again, this is I put that online on the webinar, so you can go back to it and pause on specific slides to go back to some of the consideration. Again, we've repeated this. There's all this information is available through books, through online resources, etc. So I really encourage you to look at those. And with that said, next week we're going to look at KPIs. This would be the natural sequel to today's more conceptual conversation, and the KPIs will go through some of these financial implications. With that said, let's go over some of the questions that were asked.
Thank you so much, Thomas, for this webinar. So I have, we have received several questions beforehand, but, some of them you covered during your presentation. So I would like to start one that says, can we change our business model to better adapt business and industry needs?
So the question of changing it goes back to the question of planning. So it's very important for you to have a plan, whether you stick to that plan. So planning is very important, and plan is less important than planning. So it's very important for you to be planning things. And change, frankly, if you ask to any customer, any entrepreneur, and if you can find one who's never changed the product, from the proof of concept to the product that they were scaling with, please send me an email, because I've never found one. So change is going to happen. Your pivots, through understanding your customer acquisition cost, your distribution channels, the one where the customer acquisition cost was too high compared to what you were willing to go into. All of these things, as you learn more about them, are going to change how you look at your clients, how you develop your business, what products you're going to sell, and how you sell it, and what's the price. So change is going to happen. You can be sure of that.
Thank you, Thomas. Another one that I think could be on itself could be a webinar, which comes from someone that works in the opera sector and asks how to structure the funding of a major investment in the sector.
So I think I think this goes back to webinar number 1 and number 2. So I really encourage you to take a look at this. It really depends on what's the capital structure. If you can get a lot of financing, the way you should look at financing, client first, and then you have to think about what you can finance with debt versus the value of the assets that you have in your business, equity versus the value that the equity investors will bring into your business, and how that will improve the growth of your business. So that's at a high level what I can tell you. Webinar 1 and webinar number 2 can answer more about this specific question. And certainly, you're not going to get the right answer if you don't, without really deep diving into what exactly your industry is and what are the components, etc. So I think that has to be made clear. I think there was a question about the opera and how structuring financing or funding for an opera. And, there's certainly a lot of things that you can do with an opera. You have a facility, you have high capex, or the staff that will do a show. How does that relate to impact? There's a lot of questions that I would have to ask to better understand your premise, the premise to your question before answering it. So I think these were 2 questions. So there was one question that you asked, Lisa, and there was one question that I was reminded of that was being asked. So what I can say.
There's also a very interesting question on scaling in the nonprofit sector, but maybe because that may take a long time, maybe you will answer. We get a new webinar maybe after the summer on this topic, Thomas. What do you think? And I will.
Yes, at least I think, you know, because at least I can answer a little bit of it, because I've talked so much about profit and profit no impact. If you're thinking about a nonprofit selling a product, so without understanding the premise of your nonprofit, it's hard for me to understand. I've created a nonprofit, so I know how that works, but certainly for nonprofits that compete with for-profits, you have to understand is the fact of giving profit in exchange of donation, and the implications of that in terms of your cost structure and how you're not going to make a profit and really rely on donations. How does that change your cost structure? How does that change your competitiveness? And in turn, how does that change the quality of the product for your clients? So this is what I would really try to make you think about when you're thinking about nonprofit versus for-profit rendering a specific kind of service.
Thank you, Thomas. Then a final question, which would be, why do you think that there's a different bias on for-profit and not for-profit social impact companies?
So buyers as clients or buyers as investors?
I don't know. I'm reading the question as it is, so I'm not sure what it is, what is the source of bias, and so maybe we'll ask for a clarification and we'll get it answered next webinar, because the question is not very clear.
Yep, perfect.
Okay, so we can wrap up here, and we have our next webinar next week, 1 week from today at the same time. Until then, you can go back to the 3 webinars and get ready for webinar number 4 and the last one in the series. So I wish you all a great evening and see you next week. And thank you, Thomas.